This is ominous. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have an alarming report that shows consumers are on the brink and banks are still struggling to survive. And yet this comes at a time when we hear from policymakers and politicians that the consumer is strong, that the labor market is robust, and that wage gains aren't just going to drive the economy, they're going to drive inflation even higher. And yet we have this report that says perhaps the opposite is true, that consumers are absolutely not in a good shape and nearly completely tapped out. And one thing we're not hearing from anybody is any talk about the banks, as if for some reason all of the stimulus and bailouts that we use for the small and mid-sized regional banks have worked. And yet this report is telling us just the opposite, that many of these banks, if not outright insolvent, are teetering on the edge of total insolvency. Now, if you're wondering what we're doing at the Federal Reserve today, well, let's just say they've got a lot of questions to answer. Let's go to Bloomberg, where he picked today's story up with a headline: China's consumer prices creep out of deflation in August. And I want to start here talking about China because we want to look at the health of the consumer from the perspective of inflation as we get into kind of where the consumer's really at when you see this report. Because when the consumer's hurting, well, of course, we know the banks are going to be hurting as well. The problem is the banks are in really bad shape here. The consumer price index in China rose 0.1% last month from a year earlier. The increase followed July's drop of 0.3%, giving some hope that perhaps the notion that deflation in China is over. But remember, this is just 1 month, as this is the first decline in more than 2 years. Core inflation, which strips out volatile food and energy costs, climbed a whopping 0.8%. Producer prices, which is what we care about, fell 3%. So they're contracting, but that contraction is a lot less because last month that we saw a 4.4 decrease, that from July, as factory gate deflation has persisted for almost a year. Now, why would an American consumer care about what's going on from the producer side in China? Well, you remember, all these things that we import have a stamp on them. This is made in China. So if we're seeing prices deflate out of the factory in China, guess what that means for the U.S. consumer? Well, that's deflation as well. It all comes piping back into the consumer price index at a time we continue to hear from the Federal Reserve and all of the members of the board that inflation is likely to surge higher. Well, if they simply looked at what's going on in China, perhaps they would realize that maybe there's some deflation coming down the pipe. The year-on-year increase in the CPI was mainly helped by summer travel, which boosted transportation, cultural tourism, accommodation, catering, and other sectors. The narrowing drop in the producer price index was thanks to factors including rising international oil prices and base effects. So what we're saying here is that perhaps this little increase of the producer price index is maybe perhaps even transitory. But let's look at what's going on in terms of how this all connects back to the U.S. consumer and in demand, because when we think about demand, the consumer price index is a wonderful proxy of it, because if it's decelerating or going down and even contracting, it tells us demand is going away. And when you factor then China prices coming down, well, it says demand is even falling further, because the idea here is if prices go down, demand should increase. If you see prices down and demand fall, well, that's not a good sign of where the consumer here is at. Here we can see the U.S. Consumer Price Index, this shown in blue, against the Producer Price Index for industrial activities of the People's Republic of China, that in red. And you notice the beautiful relationship here where, of course, we see producer prices in China go. We tend to see consumer prices go as well. What we would love to see here that would actually show the health of the U.S. consumer is that producer prices in China go down and demand go up. If we see them both fall, what it tells us is even in an environment of falling prices, it's not enough to spur consumption. That actually then comes back to saying that the U.S. consumer is indeed, as this report suggests, on the brink of being completely tapped out, and that even lower prices aren't enough. Some signs that the part of the economy may be bottoming out, which is the hope here. This is what everybody is thinking. Is the bottom end, because it has to be, because if it's not, then things are getting a whole lot worse, have emerged in other data released for August. The contraction in manufacturing activity even eased while the country's import decline narrowed. The slump in exports was also not as bad as expected, giving everybody some hope here that maybe now the worst is behind us. But we talked about this in the shows over the last couple of days, that there's a lot of seasonality here that's happening. You have the back to school effect. Of course, we need inventory for that. You have the holiday season. Now, granted, we might have some leftover stuff from years before, but people don't want old stuff. They want the new stuff. So we're going to see some bit of factory activity here. The question is a small amount of revival that we're seeing enough to give us the hope that we're at the beginning of a strong move higher, or is this just about it and it's going to roll over even further? Well, you know what I think. In general, the inflation still points to weak demand, which is a case we've been making, and requires more policy support in the foreseeable future. That is actually very interesting because it validates what we're seeing here. Now, looking at the U.S., does the consumer price index actually translate back into demand? Absolutely, it does. Now let's take a look at manufacturers' new orders. This is from the U.S. factory side. This in red on a year-over-year rate of change, and we see a very nice relationship here. When the consumer price index is rising, well, we see new orders rising, suggesting that the consumer price index is indeed an excellent proxy for demand. And as we see the consumer price index fall, now we should expect to see that new orders actually head down as well at a time. Again, what have we been talking about from these regional Fed surveys is there's a lot of hope that new order demand is coming back. Again, I think this is a big seasonal effect, particularly since we know starting in October the student loan repayments come back, and we also know that consumers, in terms of their credit cards, they're virtually maxed out, and when they have no more increase in their limit, well, at some point, their spending's got to go down, particularly as all these delayed effects of the Federal Reserve rate hike program come back into the interest rates on credit cards and drive minimum payments up even further. And here we can see more effects of the consumer. This from Kroger says supermarket sales are under pressure as shoppers pull back. Now, you wouldn't expect to see this type of a headline if there is a robust demand for consumers. If you're indeed seeing all of these wage gains, why are we seeing a slowdown in spending? It doesn't make sense. Executives at the biggest U.S. supermarket operator said inflation, high interest rates, and reduced government benefits are stretching shoppers' budgets. Lower-income consumers are buying smaller items and cheaper products, suggesting that indeed they're struggling here as their spending patterns are influenced by payroll and food stamp schedules. Consumers on a budget are under a lot more pressure than higher-income shoppers, which is actually shocking that anybody would think otherwise, because of course we know that high-income shoppers are generally price insensitive, but what we're seeing here is the effects of the slowing economy. We keep hearing about everybody getting higher wages here, but obviously those at the lower income tiers are not feeling it. Either that or still inflation remains way too high. But the biggest issue here is we look at where inflation is headed, we look at where demand is headed, and we see this again in the lower income tiers, is we now look at the consumer price index, still shown in blue, but now we're going to look at total compensation. This is average weekly hours of production and non-supervisory employees multiplied by their average hourly earnings, and we're going to put that on a year-on-year rate of change. And you can see again here a nice relationship that even stems back to that manufacturer's new orders, because when compensation is rising, well, people spend more money. And now we're seeing compensation fall at a time when compensation has lagged the consumer price index. And yet, what have we heard from all these policymakers is, look, this is changing for the U.S. consumer now because their compensation is now above the consumer price index. Well, you know, anytime you've gone many, many months of being behind the 8 ball and having to borrow your way to get us to stay afloat, 1 month isn't going to change anything, unless, of course, you're a policymaker looking for an excuse of why everything seems to be okay when it's not. U.S. supermarket sales have surged over the past year as food makers raise prices, citing higher costs for wages, fuel, and ingredients. Industry executives have said the supply chain problems ease and inflation cool off. Sales growth is now slowing. prompting groceries to do more to boost foot traffic and move more products. And the evidence the demand is coming down is right here in the consumer price index. There's a sub-index for food. The U.S. city average is coming down, suggesting that indeed what Kroger is seeing here, these executives saying that demand is coming down, was absolutely validated, as prices have to come down to get people to spend money. And that's exactly what we're seeing across the board here, is demand continues to fall. And one of the things that's helping that is the fact that fuel prices continue to rise. As rising gasoline prices hit inflation-weary Americans, this taking money out of their discretionary spending. But one thing that should also be rising with gasoline prices, well, that's your trading account. Let's take an update on our crude oil trade. We showed you that our CTA-Timer Pro, our program that mimics the machine positioning, but also runs a historical overlay. If you were looking at this crude oil rally here, which we nailed way back down here, and then this pullback, we showed you that it said, hey, it's time to back off or get out. Then again, it triggered a buy-in right here, just above $83 here. As of current, we're up about 4.4% on that, with an upside potential that I say could go all the way up. We're looking at potential trade here that could be upwards of 12% if we look at getting oil up to $94 a share, which I think is entirely possible. Here you can see back on our August 31st report, they've started buying up after that pullback. There was your first indicator. Here you can see now it's maxed out to alongside this on September 4th, suggesting that once the machines get in here and hold their position, that other investors will come and chase it price higher, which is often exactly what we see happen. And you too can enjoy the report and take advantage of its recommendations. We just put out a list for our subscribers this weekend, as we do every weekend, highlighting some things that they should put on their hot list. And you can get that too. It's $30 a month, and it comes with a 14-day money-back guarantee. But one thing that doesn't come with a money-back guarantee is prices at the pump. As we see, the ascent of oil prices could complicate the Federal Reserve's effort to lower inflation to 2%, which is absolutely outright correct. The increase is already weighing on small business owners, as companies are delaying upgrades, losing workers, or avoiding higher extra help and moving to charge customers more as a result of higher fuel prices. And again, all this does is sap out money from the discretionary side of the economy, and we see that kind of backflow. You see it from the grocery store. You're going to see knock-on effects in other places, because what we need right now is lower fuel prices. This is what Saudi Arabia and Russia don't get. Now, I understand that they need to raise prices because they're dealing with inflation too. The problem is, if you want a booming economy, our modern economy needs cheap, plentiful energy, and when they raise prices and restrict the quantity coming into the market, well, it doesn't do a good thing at this time, especially when the global economy is slowing. But as far as inflation, well, as you can see, it absolutely can have an effect, which will put the policymakers, particularly the Fed, on the hunt for higher rates. Here you can see the consumer price index in blue against U.S. regular all formation gas prices in red, both shown on a year-over-year rate of change. You see this beautiful relationship here, and now this increase in gasoline prices could feed back into the next CPI report that we should have here pretty quick. And of course, that would then put the policymakers at the Fed on the hunt, like I said, for even further rate hike increases, which is going to then turn and put even more stress on the banking system, as you're about to see in a little bit. But now let's talk about the consumer, because we've laid out the case that due to inflation and slowing compensation, they're not in as nearly as great shape as everyone is suggesting. In fact, this report from the Fed, and this is what we're doing at the Fed today, is trying to figure out how, on one hand, the chief there is saying, look, everything's going to be okay, we're going to engineer a soft landing, yet their own report says the U.S. consumer is on the brink of feeling completely tapped out. Ominous Beige Book warns consumers, quote, exhaust savings as recession mentions soar to a 5-year high. This headline from Zero Hedge. What was most interesting within this drab picture was the divergence within consumer spending, where according to the Beige Book, consumer spending on tourism was stronger than expected, surging during what most contracts contracts considered the last stage of pent-up demand for leisure travel from the pandemic era, which is a huge problem. But it's the other side of the equation that was more concerning, as the Fed found that other retail spending continued to slow, especially on non-essential, or there you have it, discretionary items. So what we're seeing in the report is validating everything that we're seeing in the data that we know that Powell is completely ignoring here. And the punchline, some districts highlighted a report suggesting consumers may have exhausted their savings, which we have been waiting for. And this is kind of that, Minsky moment, that black swan event when consumers are tapped out of the pandemic money and their credit card limits are maxed out. This is when spending starts to fall off of a cliff. And you think about the timing of this as we head into the holiday season, where a lot of wholesalers and retailers are just loaded to the gills with inventory and they need to clear it out. The consumers, I think, are going to be completely wiped out, and that's not a good sign. And are relying more on borrowing to support their spending if they can get it. And here we can see back, Zero Hedge had a headline last week that U.S. consumers paid for July by burning through $150 billion in savings. Well, that's not going to last much longer. While the Fed is right that households have burned through their savings, it's wrong they have borrowing capacity to support it. As we showed last month, households pay down credit card debt for the first time since the COVID crash, a clear sign that U.S. consumers are now hunkering down. And when we look at the labor market, the report said job growth was subdued across the nation. Of course, what are we hearing from the policymakers? Look at all the job openings. There's so much demand for labor. And we keep saying, look, this is going to change in a big way. Here you're seeing it in the Beige Book itself. Though hiring slowed, most districts indicated imbalances persisted in the labor market as the availability of skilled workers and the number of applicants remained constrained. Worker retention improved, but only in certain sectors such as manufacturing and transportation. In the clear sign that the wage party is over, which we've been saying is coming, many contacts suggested the second half of the year will be different when describing wage growth, as we've been suggesting that as you see hours worked fall, what happens is eventually wage growth comes down with it, and then total compensation falls, inflation goes down with the whole thing. It's all clear that we're seeing a decline in demand, and it all stems back from lack of new orders. You work through all of your backlogs. You don't need to pay people more money if you don't have the work for them. For now, however, growth in the labor cost pressures was elevated, but nearly, here you see this, all districts indicated business renewed their previously unfulfilled expectations that wage growth will slow broadly in the near term, saying bad news, this inflation story is not going to last at all. And now as we look to the banks, so here you can see completely consumers totally on the brink. They're about completely tapped out across the board. Banks aren't in a position to want to lend to them. And then we look at the banking situation that we hear nothing about. Everyone's really quiet about it because they don't want you to know that the banks are completely insolvent. And that's not a good sign as we head into a recession. Banks usage of Fed's emergency fund jumps to new record high as money market inflows soar, and we don't want to see either of those things for the health of the banks. Here you can see the Fed's balance sheet. Quantitative tightening continues to fall, down $18.2 billion. The discount window, this is the short-term credit extension from the Fed. This is nice to see. This is a good sign, down $800 million. What we don't want to see is this BTFP program, this from the Fed, where the banks take their treasury and mortgage-backed securities and lend them to the Fed for cash. Well, that's up $400 million. The discount window is short-term lending. This other program's long-term. Even we see credit extensions from the FDIC are down $0.6 billion. That is a positive sign, but here's the problem. It's not going away as small U.S. banks suffer the biggest deposit outflows since the Silicon Valley banking crisis as money market inflows soar, making the case, what we've been saying is there's going to be a second wave of bank failures at some point, except those three banks that failed, that's just the beginning of what we're going to see, because most people do not know a lot of these small and mid-sized banks are totally insolvent. And as you can see, they keep going back to the Fed and taking more and more money at a time when they need to be originating a mountain of loans to get deposit growth to soar at a time the consumers are tapped out and the banks don't want to lend to them. So you see we're creating a massive negative feedback loop. It's starting to swirl around, and at some point this thing's going to pick up speed and it's going to hit the economy all at once. And when we take a look at the banks here, we can see deposits against the consumer price index. We've got them shown both on a year-over-year rate of change. And while there's not a perfect correlation here by any stretch of the imagination, I just wanted you to note that as deposits go down, what we can see that tends to coincide with decreases with the consumer price index, sometimes with a lag. Again, this isn't a perfect correlation, but it does suggest as deposits are going down, the spending will also likely to follow. And of course, one big aspect that we're watching every week here is what's going on in the commercial industrial lending space, because what banks need to do right now is lend a lot of money, create a whole bunch of deposits, and do these at these higher interest rates so they can attract deposits back by paying depositors more money. And what we're seeing is the banking system here is not doing enough. As we see commercial industrial loans, 1.1% year-on-year growth. This as of last week. This is about to go negative. When it does, we're almost certain that we are already in a recession or about to have a major financial crisis. And this, again, the Fed just can't see it. The consumer's tapped out, the banks are insolvent, and all they want to do is keep tightening rates. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.